Um, we just finished attending it was a wealth conference, all kind of investments, not just real estate, which again keeps us humble in the world of real estate and the whole world of building wealth. We met so many people, like super wealthy and humble and like willing to collaborate and to help each other and to make an impact in this world. Um, it makes us, it makes, sometimes have you ever been in a room when you're like, I don't know if this is a room that I should be in. Like, I don't belong here. Why do I have to contribute here? It's like you start questioning your existence in that room. Well, that was us as we were walking into this room because we didn't know what to expect. And we just you reaffirm, you visualize your goals and move forward. So we got in the room and we were so like amazing connections. Like again, I think what happens is when we are so focused on what we have in front of us, like just imagine what are you working on today or this week or this month? What have you been working on? And then imagine that problem, that specific problem, whatever you just picture or you wrote down, that problem is fixed. Like just imagine for a moment that the problem that you have been battling for, a month, 2 months, a week, whatever, like, something that maybe you're just new to this business and you are just trying to find your place here. Um, and then we get so focused on that specific task, whatever is in front of us. Sorry, I'm getting distracted because I'm making sure that I have Chris in the room because I know he's joining in from a different place. So give me 1 second, make sure I don't accidentally remove you because I'm looking for him. Um, so anyway, so imagine that problem is gone for a minute. And so when you remove that thing that is so worrisome in front of your eyes, it kind of drives your behavior, it drives your actions. It keeps your brain occupied. And what happens when you take that off, you realize, oh my gosh, there's either a solution right in front of me or there's a bigger problem, which bigger problems not we think of problems like a bad thing. Is problems can be a good thing. I mean, we were just in front of like a lot of very very affluent people, and their problems that they're speaking of are incredibly like, wow, I didn't think about that. And you know why? Because we're so occupied with the day-to-day operations, with the day-to-day doing our thing, finding deals, finding partners, raising capital, getting more deals, getting them under contract, managing the portfolio. So it is so incredible to see that sometimes we need to step back a little bit and just like absorb, first of all, everything that you have achieved. Second of all, the things that don't matter, because a lot of the things that we are concerned with are not really a problem. And just by looking at the amount of success that was in the room, it was very reassuring. It was very encouraging, and it definitely opened up our beliefs. Grant and his family were there, and it was just, we continued to have that presence of the thinking big and going for bigger goals and staying committed and doing everything you need to do. And at the same time, even his presentation or his speech was questioned. I mean, some people just don't believe in the way he's doing things, and they express that. Maybe, some of them directly to him and some of them on the side, but the reality is that it doesn't matter what level of achievement you might have, you are always going to have supporters. You're always going to have people that don't agree, or disagree with the way you do things. And at the end of the day, it's you, your decisions, your family, your team, whoever is there right next to you working to achieve, is the people that you need to be the most connected with. And whether you have a team or you're doing this by yourself, or maybe you're doing this with your kids, with your significant other, your spouse, as long as you two find a synergy and find that you have common goals and maybe common challenges, the sky is not only the limit, but the sky is the opportunity. Hey, Chris, I see you here, so let me get you into the panelist. So, guys, thank you so much for joining us. Again, this being in this room um, really make us realize how, well, first of all, how much more we would like to grow and how much more we will have to hustle to get there. But it also is very inspiring to see entire families working on, not only creating the wealth. Many of them have like are like managing multi-million, like billions of dollars, and their job and their challenge, and like I mentioned earlier, their problem is now they need to preserve it. And preservation of wealth, believe it or not, I think is proven to be a little more challenging to build. And you know, I always appreciate when somebody tells me their story on how they started. Maybe you're at the beginning, maybe you're just getting started, maybe you already have a portfolio that is valued at a couple $1 million. I still remember the first time that I realized I had $1 million net worth. I was applying for a loan and I was putting all of my documents together, and they asked the value of the properties and the income and all the stuff. I was applying for a loan, and I realized, like, wow, the portfolio is valued at over $1 million. Like I was like, it's a moment that you remember, and then you get in these rooms and you're like, they're allocating checks like they wouldn't write a check less than that, $10 million. Like that's their minimum, and they have this. And Chris, you took my notes. I don't have my notes, but they have the market, the specific market that these families are at, meaning that they can write anything between $10 million check to like a quarter of a billion, so 500. Anyway, big, huge numbers. So it doesn't matter where you are. And I'm going to encourage you to put your questions here in the comments, or the comments, or just join in. We have some questions that you sent. So thank you so much for sending that. And we always want to answer those of you that are here present. But anyway, it was very inspiring in this conference to be in front of a lot of families, and that their job now, or their challenge, is to preserve their wealth. And so they're looking for different assets to invest, different businesses, and they're looking at the projected returns, and this is solid like wealth that needs to be preserved. They're not there to look for the cash flow. The cash flow phase is over. And then again, it also, um we have to come home and talk about it. Okay, like, where are we, where do we want to go, what kind of problems do we want to handle next? And the reality is that I believe that all of us can, especially, I'm looking at the list of you that are here, all of us together, we can make, those, or achieve those dreams and those goals that you guys have. Again, it was really encouraging. It was really encouraging, and also, another big part of it was to be exposed to other ways of investing. And maybe you guys are here as a coming into the real estate as a second business strategy, or a second um, wealth building strategy. Maybe you done businesses on the way on the side. Maybe you have a successful business and you want to just take that money that you make. There's three rules for money accumulation. The first one is to get money. You cannot make money, and that's one thing that we think, I'm gonna get up and I'm gonna go to work and I'm gonna make money. You cannot make money. That's actually illegal to make money. We cannot make money, but we can earn money. We can get money. So kids get money because they ask, can I do the same thing? But anyway, that's the first step to build your wealth, is to get money. So to get money, to earn money. And if you have a business, you have a profession, you go and earn money. The second step is to accumulate, but not only to accumulate, not to save, accumulate with a goal to invest. That's the step number three to build your wealth, to invest your money and multiply it. And that is where a lot of the families that like right now, maybe you're the one that is building and accumulating and investing. And then the next generation after you, if we get it right, that means that they're going to have a different problem, which is to preserve that. And that's the phase that we were exposed to. And other different vehicles of investing, we have been really focused, diversified, yet focused in real estate. All of our investments are real estate. We don't do oil and gas. We don't do venture capital. We don't do digital equity. We don't do, none of that crypto because we didn't understand. But we have a really good session enlightening all that concept. So now we're taking a couple of days to rethink our strategy and to just get new direction. We're still fully 100% committed to the real estate. However, we're thinking, what if we do in the next quarter or maybe at the beginning of the next year, can we allocate a percentage of our investment, allocation to capital to invest in other alternative businesses, and that one being possibly crypto. So stay tuned.
And
There's a lot of
and
excitement.
this is our personal funds, not funds
Yes.
that we're raising or anything like that, just so that we're clear.
Yes. Thank you, Chris.
The fund that we do have does state that we have to do real estate backed ventures, right? So whether it's multifamily, storage, mobile home parks, mortgage backed notes, things of this nature. So I don't want to skew anybody off, and the fact that I don't want to say that we've been blinded into real estate, because real estate is a great avenue and a great venue for building and growing your wealth, which is the goal for our version of real estate, right? For right now, the majority of us that are in this room want to either get started or want to continue to start growing our wealth through real estate. It's a great venue. It offers tax diversification, tax discounts, right? That or benefits that you can't get with these other asset types. But the other thing that we learned while we were here, we learned a lot more about different platforms for AI use,
Hmm.
right? And this is going to be very helpful to our businesses, to raising capital, to being able to run properties and look at forecasting and such like that for different areas, because it just, in some ways, it opened our eyes to so many other opportunities that we just didn't even think of. And that's just it. When you get around other people doing other things, you get other ideas that help you in your business as well. So that's the great part to getting around some other folks. But we're here for you and want to kick today off.
Yeah, thank you, Chris. I wanted to acknowledge some of the people that we met were international investors and family offices, and allocators of capital. And they, when we mentioned that we do self-storage and mobile home parks, but first of all, mobile home parks, it was like a huge, like eye-opening for them. They don't understand, they don't see it, and they, like Grant, when the first time that we pitched a mobile home park, he was like, yeah, I don't know why you want to over renovate. I don't like he just didn't understood the concept. And so we got a lot of questions from people that were not familiar with that specific asset. And then self-storage is getting a lot of attention. I got two again, big family office allocators that were super interested in what we achieved and with the self-storage facility investments. And again, just another room, another conversation. But speaking of, one of the topics that came up, and maybe many of you might be looking to get in this market, and you're thinking, what can I do? What can I contribute to be a general partner? What are the things that I can do? We get that question a lot. We actually had in the past, yeah, since I think you did last weekend you did a webinar, and some of the questions that came out of that was how do I become a part of the 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 deal, a team. There's many ways that you can be a part of the team. One of them specifically, because it came up, was to raise capital. Now, well, one of the presenters, and again, I don't have my notes with me, but one of the presenters was like going through how do you select the deals that you invest in. And again, remember, this is people that are writing large checks. And but it's the same principles that we follow. Like, how do I select who I invest with? This question came up in one of the chats that we're collaborators, and one of the texts that we receive after. So how can you become a part of the team? The things that the team needs is going to be always a deal. That deal comes first. When you have a good deal, when you have a pipeline full of deals, there's more for everybody, and that's what we do. We try to fill up our pipeline so that we can continue to get deals. And if they make sense, that's awesome. If they don't make sense, just underwrite and send them out. And so we do a very quick underwriting, couple minutes, and then we decide yes or not. But so that's one, finding the deal. The other one is signing on the loan if the deal is going to need a loan. Signing on the loan, and the loan is another very I would say opportunistic way to do it. If you have a net worth of yours, or if you have a history of being on a loan, the type of the loan that the property needs. And again, every property that you acquire might need a different type of loan. So being having experience and being a loan guarantor is going to be very valuable. And this can be from your business. I'm looking at some of you, like we met you in some business spaces. So you're probably thinking, well, I don't have multifamily or real estate experience, but I've been buying my own equipment and it's like a couple of $1 million each piece. So just think about it. Business, has that experience or those skills that are transferable to real estate. So when you are evaluating yourself and seeing what can I bring to a team, always incorporate what you bring maybe as a profession or as a business owner, any asset management that you might have, any of those experiences. Military certainly brings a lot of discipline and being very cautious and just being very particular on following systems, establishing systems. So, think about who you are as a person, who you are maybe as a family or as your own business, and you have to drain some of those skills that can be transferred to now the new business that you're following or you're trying to get in, which is a real estate. So finding the deal, being able to sign on the loan, being able to manage the project, so a business implementation, certainly analyzing the deal, and then having the time to manage the deal. And sometimes you can be busy at the beginning, get the deal under contract, get the deal to the closing table, and then your role might be more silent or more like less involved. However, you're still going to be involved. So just make sure that you ask the questions. Hey, what is the GP position um, implies to me, as what responsibilities do I have when I'm looking at that, being a general partner. So again, the deal, the net worth to sign on the loan, is certainly experience with signing on the loan, having the time and the experience to manage the process, having liquidity. And anytime that you ask for a loan, the bank is going to ask you to prove liquidity. So depending on how big the loan is how much you're gonna need to have liquid on, and usually it's about 10% of the loan, the amount of loan that you're asking, and then having the ability to bring investors and raise capital. So let me see. I think that I see a question. Maybe. Uh,
What are some
uh,
new ways you are learning to incorporate AI to grow your business?
Yeah, that's a great question. So there are so many integrations that you can have. First of all, if you're out there networking with people, you are making the time, putting the resources to be in the places or travel there or buy the tickets to get to the rooms, you pay to play. So you're doing all of that. And then what we see often is that many people, they just meet people and they never follow up, never trace where their contacts come from, never organize anything, and next time, next year they see the person again, and it's like starting from scratch again, like, oh, I never met you, because you don't have that record of have met them. Also, once that you meet them, and having a CRM, and if you need a CRM, let me know because I can help you with that. But having a CRM stands for Client Relation Management Tool. It just helps you to communicate with your, maybe it's 10 people, 100 people, 1,000 people, 10,000 people in your database. So those people that are in your database, how are you communicating with them? How often do you stay in touch with them? What are you offering them, giving them, maybe a newsletter of some sort? So it's just the way that you communicate with your investors or potential investors and partners. So a lot of that, I will say about 98% of that can be delegated, and automatized. So there's a lot of technology that you can use, and I encourage you to use it. We certainly use it to make it so that you don't have to be there every single hour. Sometimes we schedule texts to reach out to our database, and those texts are done every hour. So I just don't have the bandwidth to be in the CRM every hour. So there's ways that you can amortize. There's ways that you can be in more than one place. You can build your own agent, AI driven agent, and educated and program, so that it answers like the way you will answer the question, integrates your experience. It's so super cool. Like, you can set up your automatic receptionist pretty much, and they can handle calls from you, and it doesn't take the human connection from the process, because all they're doing is taking the call in your place when you were not even available to begin. So if you were available and your phone ring, you're probably gonna answer it. But if you're not available, if your telephone ring, at least you have an alternative way that the person that is reaching out to you, they're making the time and giving you that attention, to reach out to you. And then if they find a closed door, was probably going to be like, okay, well, give it a try. Let me just remove them from my list. Or if they were kind of like and questioning whether if that person is going to help me or not, all of a sudden, yeah, you prove that you can help them. So making sure that you have that way is that extra help of hands or ears or brains, that is it can be built into your CRM. Let me see. I see another questions. I love questions, so keep them coming. I just don't have my glasses. Is sweat equity and bringing a deal realistic enough to entice sponsors when we lack of capital, net worth, and liquidity? Uh, we were searching, but now we are broke. We
Here,
built it.
I gotcha. I
Okay,
gotcha.
sorry.
Let me help you out.
Thank you.
We were searching in Beaumont, but now we've pivoted to the Houston MSA because we've had troubles attracting sponsors. Thanks for doing this webinar.
Great
Absolutely. And
question.
Jordan actually reached out earlier today and I gave him this link. Said this will be
Okay,
the easiest way for us to answer questions, especially if they're
thank you.
semi-generic, that we can help others to understand as well. That's really what it boils down to. So, yes, finding a deal that does work would make a huge difference. It does find a way for you to come in and be part of the deal for sure. Um, but it's the rest of your participation that's really going to help you to earn more equity in the deal. But as we've always said, it's getting that first deal that's one of the most important and one of the hardest tasks for you to do. Um, as far as a general partnership team, we really do break it down with the fact that there's the portion of the team that's going to be responsible for finding the deal. And amongst that is also getting it to the closing table. So having the vendor relations um, with brokers for mortgage brokers, lending brokers. Oftentimes it can be a different person even who's got the deal, the broker, listing broker. That's what I meant to say, not lending, listing broker relations, and that helps to get that deal. And then you have the legal representation and such like that, and who's able to participate in that process to bring it to the closing table and bring those vendors to help. Also, due diligence and property management. Then we have the folks that are willing to do the hard money. And you said, if somebody doesn't have capital, you can still be part of the team without having to put in the capital. It just means that other people are going to get compensated for that portion. Signing on the loan, again, net worth, liquidity. If you're not able to participate, then you can't expect to get that section of equity within the general partnership. And the final section was the asset management, along with investor relations and raising capital. And for that, we can usually find a way to get somebody a little bit of equity because even if it's your first deal, you're there to learn the process. And we want you to be vested in the concept of, hey, I'm making money to do this, right? We don't want you to say, oh, I'm here for education. I'm not getting paid. I'm just doing it just because I want to learn how to do it. Are you really going to pay that much attention to it 3 years into the deal, not being paid anything? Probably not. So we want to make sure that you have some equity there so that you're able to put in the effort so that you can increase your amount that you're going to get paid along the way as well. Right. But yes, absolutely. Now, Houston over Beaumont, it just depends. Depends on where it's located in Houston, right? It's a huge area, lots of suburbs, and some areas that just aren't that nice to be in. So uh, I would say maybe a year and a half ago, Beaumont wasn't in an exciting spot, but now we're starting to see Austin stretch out, Houston stretching out a little bit. And I apologize. I have to think about where Beaumont is. I wanted to say it's like 30 minutes outside of Austin, and then all of a sudden it's like wait, it's down on the coast southeast of Houston. So I think I'm thinking Bastrop with the first thought. So Beaumont being right on the water may be a non-starter for some people because it is right there, and they do get hurricanes. Again, I hope I'm thinking about the right location. So, with that in mind, the Houston as a whole, yes, people would probably be interested in partnering for that. Um, People would be more apt to partner for nicer areas of Houston than they would Beaumont on Beaumont's northeast of Houston, just a hair. We actually have something in, where is that park?
Yeah, this
Nope.
Corby.
Is it Corby?
Corby
Where's
is
where's
in
Strala?
Houston.
Strala's the one.
Yeah, that's in
Yeah, that's
Houston.
the one. Crosby.
Crosby, Crosby.
Crosby's the place. So we're part way to Beaumont. So neither one would really scare us, right? We're halfway to both. But again, it depends on the deal and how well it cash flows. Beaumont, I wouldn't expect it to appreciate as fast as Houston could. However, it could also not be as impacted as Houston was, like it has been for the last couple of years because of the interest rates and overdevelopment, overgrowth. That interest rates kind of went flat to negative in some areas of town. So all of that falls into play when you're
Um,
looking at these different MSAs.
so the person that is asking if you can put it where you're chatting, it says if are you in Beaumont? I'm sorry, I can't pronounce that. So
Beaumont,
Beaumont, are you there? Monrose. Okay, Monrose, let me say. Are you in that area? That's my question to you. If you can put it there, or just raise your hand and we can bring you in. But the question is, because it sounds like we have an SEC attorney, which again, that's and we have that. Anyone can get like here, can I have an introduction to the SEC attorney? So that doesn't really carry a lot of value, and I'm being honest and like just let's suppose that you partner with somebody that has the seniority. They probably already have the SEC attorney, the real estate attorney, the broker. We also have brokers, so again, make sure that like if you're the one finding a really good deal, that's your forte. That's what you bring to the partnership. So but it sounds like you're asking if there's a lot of hurricanes. We are not familiar, so I mean, okay, so yeah,
yeah,
let's see.
it's right on the coast. I caught what he was saying.
Planning
Montrose
to
is
move
right.
there,
Montrose is right downtown. It's off of Memorial Drive, which is where it's actually closer to downtown
right?
than Elon Memorial, just so that Maricela has an idea,
Yeah.
which is probably also not very far from two of Grant's properties. They're right in that general area as well, because we can actually see Grant's property from this other one that we have in Memorial Park, right on the edge of Memorial Park.
Yeah, so if you're willing to move there, certainly that carries more
Hmm.
value because a lot of people are they're tied to their jobs or their residence and they're not willing to move in. So you can bring a lot of value by being boots in the ground and finding the deal, especially if you have that relationship with the broker that makes it so that you don't the deal is not even in the market or it you got it before it went to the in the market. You have to be careful with off-market deals because it can be both way. It can be a deal that is being shopped internally before it goes out, and they're just trying to sense or feel the market. So you have to be careful with that. We've been in a situation where we try to do offer off market before it hit the property hit the market, and we were offering a price and we knew the sellers, and so we felt like, oh, let's just try to do a deal off market. So the sellers were committed to their investors, which is the right thing to do. They said, well, no, we're going to take it to the market just to make sure we are presenting the investors the best opportunity to sell or the best price to sell. And so they took it to market, and we ended up getting that property for about $500,000 less than what we initially offer or willing to offer. So again, the being in the market might actually not hurt you, because when they started getting offers, the offers they were getting were lower than what we initially thought we could offer, and definitely lower than what they wanted to get for the property. So when we got into the hat of with all the properties, we were an attractive buyer because they at least knew us. They didn't know any of the other groups. So again, you have to be careful because it could have been something that it came to the market and then everybody was overbidding of each other, and then whoever got the highest price is the person that was going to get it. You just don't know. You don't know the like behind the scene. You might not even know it after you close, but sometimes all of those facts, like the connecting the dots factor, might come after you close and you're like, oh my gosh, that like now we can look back and think like, wow, that was actually a good thing that they took it to market because they got their desire, which was to do the right thing for the investors, and we got our desire because we were able to get the property for less, and because they got feedback from the other potential buyers, they realized that the price that they were looking to or looking to sell it for was, higher than what most people or the market mandated. So again, can be either way. So you see the other question?
I did. And so the other one was a question around capital raising, excuse me, earnest money. Is there a way to get around the earnest money need? And that comes with finding a partner who's willing to do the earnest money, who's willing to put in that earnest money. Another option for that is if you have a home equity line of credit or a business line of credit, maybe you can use the line of credit to pay the earnest money until closing. When you go to closing, you get that, you request and make sure your partners know, hey, I need that money back at closing. And so now you're getting credit for putting in the earnest money. You pay a little bit of an interest rate while the money's locked up as the earnest money. And then at closing, you're able to get that money back, pay off your loan, so your business line of credit is available again to you. And so that's one way to work around needing the funds and having the funds available because many of us have equity locked up in our building. And this is a great avenue for having it available to um, to be able to utilize the equity in your home. Now, the one caveat I will say to that is if you lose the deal, if you do not close the deal, and your earnest money was at risk to be hard, then you are putting your money at risk. So you need to make sure that you are, in fact, able to pay your mortgage payment, your new line of credit payment, whatever that might be. Should you not, should you lose that money and not be able to put it back in to pay off the loan? So I gave you both sides to that story because you need to be prepared for the downside if you don't close the deal. Now, the other side of having a partner, That partner needs to know about the deal. That you can't just walk up to somebody and go, "Hey, man, I need $250,000 earnest money day one of close of the contract." Right? We got to build that relationship with people, get them to know and understand, and see our way of underwriting. Make sure that you're on track with the business plan because they're going to become a partner if they're putting in that money. You
Yeah.
cannot use a passive investor's money at risk before the deal's closed. So you can't use it to pay bills. You can't use it as earnest money. You can't use it as hard money. You can't pay the lender their application fee with passive investments. It has to come from the partnership team. And I know that people have heard the story that, hey, you can buy these properties with no money. You're right, you can because you can go back. All the funds that you guys put in, you are welcome to request it back at closing, but you have to raise the extra funds from passive investors so that the money is still available to pay the bills, right? Because you paid your bills during the time frame that it was necessary, and at closing, somebody else is going to slide in the place in the position of having paid the bills, but it's as a passive investor. So they're not getting equity for the deal because they put their investment in. They're not getting equity on the GP side. They're only getting passive investor equity. So that's the way that you buy these properties with no money down. It's not your money that went down, right? Once the deal closes, but somebody has to put money into the deal in order to move forward in the deal.
Yeah, so the question was to clarify, this is fine to, I guess, to put the escrow, and if you lose it, it's fine as long as they have a GP. Yes, as GPs, we put our money up front, and if for whatever reason that deal doesn't close, that deal is at risk. And if we have to walk away, that means that depending on what contingencies you put in your PSA, in your sell agreement, you might be walking out of your, the losing that money, but it's never from the passive investor, which is, it's definitely a no-go. Let's see. I think Chris, you're answering some of that.
Yep.
Um,
Let's see. So we answered the GP question. Earnest money is there a workaround? Oh, and filling out SEC questions.
mm.
Uh, what I'll say the SEC questions are, it sounds like is probably for doing your PPM, and you don't need money to answer those questions. You need experience. You need to understand your business plan, because that's essentially what they're asking for when you're talking to legal and you need to do those SEC questions. You will need money to pay the retainer for them to start doing your paperwork. The private placement memorandum, the subscription documents, they will usually include one entity, which is the ownership entity, as far as formation for that, and an operating agreement in alignment with that.
So Chris,
So, yeah,
I want to clarify just so that we don't confuse people, because we are reading the questions and they're not reading the questions. So we need to give the context so they orient themselves to where the conversation is going. The first question was in relation to um, the way I read it was like, can I use the LP money to put in escrow? Escrow meaning, for those of you that maybe are doing only residential, escrow is the money that you put in the title company and an escrow account to initiate negotiations after you sign the PSA, the purchase sale agreement. So this is when you're under contract, then usually you have a handful of days, usually 3 to 5 days, to
3 to 5.
put money in an escrow account. That's just in good faith. You're moving towards closing. This is what I'm putting here for, the fees or extra expenses, or then or ordering the survey and the appraisal and all the stuff. So they want to have that money locked in there. So that money that you put there, when you just went under contract, 3 to 5 days after you go under contract, you don't have a PPM in place. So even if you have a PPM in place, this offering is not open for investors yet, because I mean, well, we wouldn't, because what if we go and do diligence and we found something terrible about the property and we want to walk away? We don't want to have to be returning investors' money. So that's why we don't take any money until we have the PPM, which then allows us to go and sell securities, because that's what you're doing with your raising capital for this private capital for these syndications or for this group buying, that you are selling securities. And selling securities, you have to have a license. The only way that you get away with not getting a license to sell securities is to file for an exception. And the only way that you do that, filing for an exception, is when your lawyer prepares a document that is justifying that you don't need to be publicly trade or publicly announced, and this is such a long, different process. So so that you don't have to go through that, there's a couple of exceptions that you qualify for. So one of them is like you don't take investors' money, passive investors' money, to trade or to benefit to as a group. So that's why you don't take money before the PPM is ready and be reviewed by your investors. So any money that you have to put in before you start raising capital, because there's going to be money that you need to determine if this property is a good property that you want to pursue, a property you want to evaluate, make sure that everything inside the guts of the property is good to go, and then you can, move to being under contract. So in order for you to have access to this property, the seller is going to ask you to put something down, more skin in the game. So a lot of the times you do have a due diligence period, but if you need to extend, or that only starts once that you have your contract in place. So anything that you have to do before, it's going to be at the expense of the GP team, not the LP. Again, because if you have to walk away from the property, the money that is lost, because if you hire a photographer or if you hire an inspection agent, they need to get paid. They did the job whether you pursue the deal or not. So these are third party vendors that they're gonna come and give you the service, and they expect to be paid. So if you have to step away from the program the property, then that money you're gonna still have to pay them. So where is that money coming from? From all the GPs. So you have to be very, very careful, because sometimes we get a property and you get excited and you're like, I'm gonna move forward. I'm gonna start raising capital. We've seen so many people in our communities that they initially start raising capital. They don't have a PPM, they don't have a structure, they don't have an offering for the investor, they have not qualified for the exception of the SEC, and they're already out there. Hey, who wants money? Who has money? I need liquidity and I need this and that, and they're not even making the offer to be a general partner. So you have to be very, very careful as an investor to understand at what part of the acquisition process I am gonna put my money in, and pretty much what secures my money. So again, I just wanted to give that explanation, because there was so much behind that question that if we don't explain to the full context, people might start getting confused. So thank you, Chris, for listening. And I think there's another question here.
What
Two
percentage
questions.
of offer price should be allocated for earnest money? That depends on the market, depends on the MSA that you're in, and most brokers will say, hey, it'll look really strong if you put in 1%. But again, it also depends on the size of the deal. So if you're only doing like a 500 to $1 million deal, they may want more than $10,000, right? They might want you to put 25 or 30,000 in just to make it look a little bit more robust, I guess I'll say. But if you're doing a $30 million deal, then you may want to put in 300,000, and that's appropriate. And you just took away that question, so I
Oh,
missed it.
oh, there's an email we need to respond to.
Oh,
So,
okay.
yeah, if you send us an
Oh,
email and we haven't responded, we apologize for that. We went in a mastermind for business owners in Spanish. Thank you, Chris, for being there, fully present and taking notes in
and
Espanol.
participating.
And participating. And that was in California. So I love the Californians. I see some people here that were in that event. It was amazing. Yeah, I love seeing people succeed. I love, my people to be successful too. So it was such an encouraging and just like revitalizing event that we attended. And then we
I'm just
travel.
I'm gonna
Mhm.
add and say my people is also the people in this room. So
Yes, of
as
course,
in
of course.
when you say it,
I don't mean
it's not just Latinos. or
No, no.
Latinas.
What I mean is like, yeah,
I know.
absolutely, you're absolutely right. But when, like, I said, listen, this we did that event, and I don't know how many people here is from different countries, but I'm from Mexico. Like, it's such a, it's like chicken soup when you drink something that is so soothing to the body and to, just feel so loved. And when you have this information and you receive it in your primary language, it's amazing. So I don't mean offense. I love you, all of you for being here. High fives,
No,
kudos. I love you.
you're
Um,
good.
and
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 and along those lines, my head hurt by the end of day two. My
oh
head
my
hurt
God,
because it wasn't my primary language, but I did my best to keep track, follow along, and enjoy and participate. So, no, we
that's
appreciate
awesome.
you guys, and but that's a big reason we are a little behind on our emails and stuff. So, gracias to all of you. Thank you.
That's awesome. Toda mi
I
gente es la
love
que
it.
es amable. This is it. All the people is the people that is gentle and nice. That's true. No, no, no. I didn't mean any offense. I apologize.
No.
But anyway, so we were in that mastermind and we like red-eyed to New York, and so we've been on the go. We still have another month to be pretty much anywhere. We're gonna be in New York City tomorrow, visiting some friends and some partners, which is awesome. So stay tuned. Like we have this hashtag Oplex on the go. Anytime you want to see where Uplex is, which is us, just look it up and you'll find us. Anyway, so yeah, I think I covered that the question that was asked about let's see about there's another question here. Are you in the
Yeah,
Midwest? How
I've got
long? Oh, I
you
love
good.
this question. So we are in the Midwest only with a self-storage facility. We're always looking for other properties. We just connected with somebody that has 600 doors. And by the way, if you're looking to buy doors, like this guy has a portfolio and he wants to scale and come to play with the bigger properties. So this is in Georgia. But speaking of Midwest, we are looking in that area. We bought last year a self-storage facility. And the second question, I think Chris, you elaborated that at the beginning, how long you've been in the in real estate investors. I don't know if you want to answer, you
No,
want me
you
to.
you spoke at the beginning of this one. I spoke last time at the beginning, but we've been investing in real estate since 2006. We grew to 35 doors by 2020, and then we met Grant in 2021, sold our doors, flipped them into joint ventures and syndications. And today we're in just about 3,000 apartments, four mobile home parks, and three self-storage. So we appreciate the question. Are you open to investing areas outside of where you live? Chicago, to be exact, multifamily specifically. Chicago is tough, only because, and the first answer is yes, we're open to other areas. We like wherever somebody else is that we can get insider information from the boots on the ground, but it's also important that we're able to corroborate the story, right? Verify the information that we're being told. That's the biggest things is to be able to trust our partner that they do know the market, that they know what they're talking about in that area and that we can back it up with some research to verify what we're being told. Chicago, New York, there's other blue cities and blue states that we generally don't go into only because of the difficulties in management. They're not landlord friendly, they're very tenant friendly areas, and that makes it very difficult to remove people from the apartments. There are people who make money in these areas. Like, I won't lie, there's people who make money in these areas, and there's others that buy them just strictly for the tax benefits and hold on to them for decades and decades, and they wait for the appreciation to happen. They know that they're not making money each year, but maybe they have some other source of revenue that they have to get rid of some in order to show a loss on their business or something along those lines. So Chicago's not as exciting for us, but we would say Indianapolis is something that we've looked at multiple times. We're already in Kentucky, Lexington, and we just left out of Louisville, and we've looked at Tennessee before for those areas. And then everything else is pretty much from Maryland, Virginia area, down and around, all the way around to Texas, skip over to Arizona. So we're open to pretty much everything in the Southeast, portions of the state, from Tennessee on down and out. So I think that answers all the questions
Yeah.
on that side of it. So thank you. We look forward to being in New York and yes to Virginia. staying away from the immediate DC space, and but the rest of the state is pretty friendly for use. And yes, so we've looked in Tyson's Corners before. We've looked out near Fairfax. We've had some people present some stuff in the Hampton Roads area that just didn't. Those deals many times they just didn't make sense. The one in yeah, it was Tyson's Corners. The price just went too high because it was institutional quality, and they needed institutional returns where we needed retail returns. So Washington State is a no. Oregon's a no. The Pacific Northwest is pretty much a no. But we do have some people that own some single family up there that they were looking to liquidate if anybody has interest up there as
I was
well.
gonna say we have, I think it's like a 10 or 11 homes that he's willing to sell as a
Hmm.
portfolio. So and we told them and anytime that anyone is selling something or wants to just reach out to anyone in the community that you're part of it. Maybe we don't know them, but we might have in some way connections. So just reach out to us, send us an email. We'll be happy to make an intro.
Yep.
So I just put here in the chat, and give me thumbs up if you can see it. I just put it in the chat for everybody to you see it. This is a YouTube channel that we started recording, like I think it's going on 5 years now, and we talked a lot about us. And the reason why I put this here specifically is because somebody asked about us. So we obviously have not done a good job telling you who we are, what do we do, how long have we been doing, what can we collaborate with. So that playlist is specifically tailored and curated so that the first time that we meet and you don't know anything about us, at least you can have some not only telling you about us, but also what are the things that most people ask in the first 6 months. Because I mean, if you were to tell me, when I first got into this market, this business, like the first 6 months you're gonna be lost. The next 3 months you're probably gonna be like, okay, I think I got it, but you're gonna be full of fear. That's exactly what happened to us. So in that time frame, I was very smart to document everything. I documented every question that I will receive, every any question really, and the calls that we got or goal was to make at least 5 calls a week with anyone that just wanted to talk real estate. So I gathered a lot of information, and what I noticed that is that it was very repetitive. The repetition of the people asking the same questions and same questions over and over. So what we did is like we make a list and we answer those questions and we sit down and recorded that. And so that's one of the videos. But we also talk about loan assumptions, acquisition timeline, how to find a partner, how to put your group, your sponsorship group together. So we answer a lot of questions. So the more questions that you send us, the more that we're going to be producing content and sending that to you. We that leave that last. That list that I send you guys is as a live list, meaning that when we do a webinar that we feel like there was great questions to share with everybody, we just put it there. So just always be, usually once that you get into that list, you're gonna get a notification. And when I add something, a new video, remember I'm all about using AI to automatize my reach outs, and I'm letting you know, hey, there's a new video, you might want to watch it. So seriously, just save that as your favorite. So put it somewhere so you can click on it when you're commuting or washing the dishes, whatever that doesn't require your full attention. You can always be consuming that content, and it's repetition. Every time that you listen to a recording, whether it's my recording or somebody else's recording, you're gonna get something different. And what happens is that when we hear something, we might not be ready to receive it. We're not dealing with that problem. Therefore, it's like we're adults. We have the adult learning modality that if it's not in a hurry right now, I'm probably gonna just ignore it until I need it. That's if you have kids, that's probably what you do. That's how you live life. So make sure that you review that and then being intentional. Learn it as if you're gonna be the one watching, I mean, teaching that here today. So that's how I learn and that's how I master this material, repetition and then just continuously spilling it out of your mouth, verbalizing it and sharing that with other people that might be a couple steps behind you. So anyway, that also builds your potential partner pool of partners or investors. So that's an extra tip for capital raising. Let's
It builds your
see.
confidence and it makes sure that you know the information because you want to make sure you're passing the right information along. And again, it builds your confidence in the process and also in you, right? The first sale of the day is selling yourself that you know what you're doing, that you understand it. If you don't understand it, then you need to ask somebody for additional information so that you do understand it, and that way you can feel comfortable and confident moving forward.
Great. Thank you so much, Chris. So how do you manage outside of the States and how does that work? That's the next question. We have a couple more questions and we have about 3 minutes so we can keep going. If you have to leave, we understand that you were here present and but if you have questions, just put them in the chat and we'll make the time to answer.
So, how do you manage in different states? How does that work? We use property management, and uh, so we're asset managers, not property managers. And the difference is doing the day-to-day versus looking at the big picture and ensuring that the business plan is being performed appropriately. So we do check the financials. We do have some input to the to the property management company, but really it revolves around the bigger picture of KPIs and metrics that they need to meet with new leads, new leases, move-ins versus move-outs, renewals, talking to vendors, getting 3 quotes for vendors, all these different things. So when you own a big enough property or a big enough portfolio, the property can afford to pay a property manager to have people who are on site. When you have something a little bit smaller, like 60 to 80, I'll say under 80 units to about 20, 25, you can afford offsite management sometimes. And below that, you probably have to manage it yourself. At least initially when you're first buying it, because you still have to enact a business plan to increase the value of the rents. So you have enough revenue and enough spread afterwards, enough cash flow at the end to be able to afford that property management company. How long has it been since you've paid taxes? I'm sorry to say we had poor planning this year. We had to pay 800 and I think $64 for 2024 taxes. We just signed that document yesterday. And I'm sure Maricela is like, "Ah, it's close enough to zero. We could pay nothing." But uh, in the interest of being transparent, we paid $864, not thousand, just dollars. So,
Oh
anyways,
my God.
take,
And
thanks for
that's
rubbing it in the salt there, man. No,
I love it. All
no, that's
right.
great. Otherwise, we hadn't paid taxes since 2020 was the last year we paid federal taxes.
Mhm. Yeah,
All right, what
we
makes a
hated
good
writing the check. That's awesome.
Yeah, yeah, we did. What makes a good tertiary market, or what metrics do you need for a tertiary to be worth it? What population is necessary, job growth percentage, home ownership versus renters, crime rate, etc. Well, you have a great list of categories there. And basically, you want positive numbers, positive expectations, right? So job growth coming into the area, population coming into the area. It doesn't matter if it's 0.05, 0.025%, at least some population growth is good. The downside would be is if they're building like multiple multifamily properties in the same area and there's only a 0.25 expectation of population growth or job growth. Because then that means that they're bringing on too many apartments onto the market potentially. And that could hurt your market. When we underwrite the deal in a tertiary market, we are definitely underwriting for a higher level of cash on cash return to the investors. And the reason for that is because you have to make it a cash flow play as opposed to an appreciation play because these tertiary markets generally don't tend to appreciate as fast. They will be advertised as like Houston MSA, like Beaumont. Let's just use that as an example. It's probably advertised in some ways as a Houston MSA because it's what, an hour, hour and a half away, but it's not. Let's be honest. It does not rely on Houston for any part of its income and potential. People generally don't live in Beaumont to go work in Houston. They might make it halfway there and work somewhere halfway, or maybe right on the outskirts, but they're not going all the way into Houston. So, and crime rates, same as we would anywhere else. We don't want gun shootings every week and arrests and all this other. We want neighborhoods that we would like to live in. And if it's not a neighborhood I want to live in, then we would just want a neighborhood that's safe enough for somebody else to want to live there, right? Our properties, some people will be like, oh yeah, the property has a gate, the gate is all fenced all the way around. Yeah, there's gunshots outside the property, but that's okay. Well, no, it's not okay because they have to feel safe getting to their house. Just because your house is safe doesn't mean the neighborhood is. So just make sure that you're looking at those things as well. What did
Great
your business
question.
plan, yeah, what did your business plan look like when you started considering you are consistently acquiring properties?
I can answer that question. So
Please.
when we first transitioned, because we have built our portfolio, we were cash flowing, we were in what we thought a good position, and we were. Then we learn about if you wanted to grow and get larger properties or more properties, we needed to partner with other people. And so we initially invested with our own money. We then invited a few people, like two or three people, my brother being one, and a classmate that I went to doctorate school with another one. So we kept that very, very, very tight. We just wanted to make sure that we just didn't want it to, be selfish. We didn't want it to answer to other people and wanted to work for other people. That was my idea. I was like, no, we work really hard. We are making really good. I mean, I'm open to open this opportunity to the people that supported me and my family. But at the beginning, we were just doing our own. And yes, you can do your own for only so long. And one of the things that our mentor taught us was most people when they want to keep full control of the property and get all the profits, you're going to do it once, and then it's going to be so heavy on you because you're doing all the work, and it becomes a job. And we didn't want it to have another job. We wanted to scale. We wanted to treat this business in a professional business, being able to perform for its own and pay its own bills, and not necessarily depend on us or our name or our income. And that's exactly what we did. We structured to do partnerships and group buy-in. And so after doing that, we definitely saw that the flat line going up a little bit if you're doing like, a little bit, and then all of a sudden with partners and buying larger properties or portfolio and net worth increased drastically. And we saw that as a possibility, and we implemented. So that was our business plan. First to build it, get a cash flowing portfolio, and then sell it, exit that part, and go into larger properties. So that still continues to be or a main business plan. Now, our business plan also, when we started selling, we realized that some of the properties that we were investing didn't have a lot of cash flow. Some of them were cash flow high, but they didn't have a lot of depreciation. So because of that, again, if you listen to the playlist that I send you, you wanna see our transition. But we decided to incorporate other type of assets that we bought them into the real estate and into our portfolio to balance that, because we wanted the cash flow, we wanted the depreciation, and we certainly wanted that appreciation of the assets. So that has been our business plan all along. And I think there was a second part of this. Are you
Yeah.
acquiring, that's an excellent question. Are you acquiring properties consistently? So, like in the past 2 years, the market has been so bad. Just nationwide, the acquisition rate or the trade rate, the properties that were actually sold, not just like shop for. We on the road so many deals, like a large amount of deals that we on the road, and the deals were just not penciling out. Like our gap, like maybe our offer came to 20 million, and the seller wanted $28 million. So that gap between what we could achieve or we feel comfortable with offering and what they were wanted to get from the property, it was a huge gap that there was no way, not even going after negotiations and being aggressive in negotiating, it would not get that gap close. So just to put it in perspective, last week we submitted an LOI for a portfolio we offer $65 million. They want $70 million. So as you can see, the gap is getting closer. But to answer your question, to go back to your question, that you acquiring a lot of proper or consistently acquiring properties, we acquiring properties that meet our criteria. They need to be cash flowing. They need to be able to pay back to our investors. And we are open to markets, like we mentioned before, to other markets, as long as we have the support and the boots on the ground. But we are not just acquiring properties because we want doors or more units in our portfolio. That's not the game we're playing. And so we've been very, very diligent and disciplined, and not just jumping on properties that are not cash flowing or are going to need a lot of weight from our and our investors' side in order to pay. So because of that, we have been acquiring a property a year. And I know it sounds hideous, 252 units, 246 units, and then so that's been our acquisition in the past 2 years. But again, if you look at the nationwide trade rate, has dropped probably about 80% in 2023, about 70% 2024, and it's starting to pick up this year. So again, we have been really disciplined, and because of that, we also did a lot of private lending money. We created a fund to be diversified so that we understand that people still want to continue to invest in real estate, but they don't want to do all the legwork that goes into vetting different type of assets, different markets and portfolio structure. So instead of that, we do what we call the white glove. We do the turnkey investing. And so when you invest in our fund, you are diversified. Your capital is diversified across different assets. You get to learn more about different assets. That's the beautiful part of this. You're not making the decision or not sitting on capital, which is the worst that could happen. What's the worst that could happen if you don't invest in this year and then you wait until next year because maybe you're waiting to, you know, get your own deal, or maybe you're still hustling and don't have the time to vet opportunities. What's the worst that could happen is that you're probably just going to sit in your dollars, and the dollars are going to lose value. We're seeing a lot of properties making sense. We are turning in a lot of LOIs, and we have something under contract right now, and that property is just it's a steal. Grant Cardone call it the ugliest property and the portfolio that has the most upside for bringing capital or profits to our investors. So we're very strategic in that regards, and acquisition so it has definitely slowed down. But we, as creating a community, nurturing our relationships with you guys, and being in rooms that have the potential to bring deals, that's exactly what we've been doing. So we in the
I want to
military.
I want to kick for a quick second before you transition too
Mhm.
far off. Is you were talking multifamily cash flow and all that. Somebody had asked in there, and I just cleared them out because I was like, yeah, this all runs together. I thought for sure you were going to hit it.
I didn't see it.
But they asked about the cash flow on mobile home parks and the cash flow on storage, and what the returns kind of look like on those.
Got it. I mean, it's 9:10. I know you have another call. I can stay here, but I definitely encourage you guys to go into the playlist. If you haven't yet, just click on that link and have it open, save it. Because we actually do a comparison, like a case study where we present the returns for multifamily storage, mobile home parks, not only the cash flow, but the tax benefits, and we do the tax benefits, the liquidity, and as well as the appreciation of those assets. And then we compare that to a blended investment opportunity that we have. And so I spent probably about 40 minutes talking about it. So I don't know if you want to just quickly go through it, or we just hold them
No,
accountable for doing
I was
review.
literally, my expectation in answering the question was to say, we underwrite for usually somewhere between 6 and 8% on both storage and mobile home parks, but they have always performed better than that. I'll say pretty much always performed better than that. We actually had one park that was actually paying us almost 2% monthly. We decided to do an expansion on the project, and so we stopped. It was a joint venture, not a syndication. And so, as a partnership, the four of us decided to halt distributions while we do the expansion. and so we're working towards building that back up. But 1% monthly was coming in from that park. The storage, we literally just sold a storage, and about a year and a half before that, we sold another storage that we had a partnership on. The one that we just sold, well, the one we sold a year and a half ago, we only owned it for 13 months. I think we did one large distribution in the middle of that first year. And then we decided we were selling the property for personal reasons of breaking up the partnership. So, and both properties were owned by the same partnership. And when we sold that property, we owned it 13 months and we got a 32% return on the investment. And then with the property that just sold, we owned that for 4 years and 4 months. We 3.11x our money, 3.11x our money. So on the investment side itself. So we bought that one at 485 and sold it for 810. And really, it was pretty simple. So cash flow wise on that property from the 4 year, we projected 6 to 6.5% returns. First year gave 6, second year gave about 11, third year 15, and the fourth year we owned it, we got 20% cash on cash returns. So they really, really performed very well. The difference for us is, and the reason that we still do the multifamily is because we had to pay $864 this year. The depreciation writes off our income. So we're very blessed that the multifamily helps us in that way, and we know that it's going to have appreciation when those sell. They're going to do really well, whether they have great cash flow during the whole period or not. They should do very well and also help us to achieve those things. We had a multifamily. I think it's the second video that she was talking about that we discussed that we went into passively. The update on that one is we sold it 23 months in. We got a 62, 65. I think it was a 65% return, ended up with just over a 32.5% annual return on investment. So, yeah, all these properties do very well. All asset types do well in the end. Sometimes you don't see the money until you sell it, but for the cash flow side, we definitely like mobile home parks and storage. So with that,
All
I'm
right.
going to take off. It's up to you on whether you're staying for more, but I do have another call in a little bit and I have a few things I need to do. We'll see you later. Thanks,
All
Chris.
right. Thank you, Chris. Thank you so much. Hey guys, so t tell me, put your takeaways in the chat. I love hearing your takeaways or any questions. What I can tell you is that based on the what we saw in the rooms, this is again big rooms, different rooms that we're stepping in, and what we see overall is that people regrets not getting started or not diversifying. Those are the two things that I took away from being in these rooms where people has like the ability to write big checks. And the biggest thing that kept coming back from different speakers was that they didn't get started early, or they didn't held, like they sold too early, because they have the ability to hold it. Sometimes as a syndicator, as a group buying, you have to meet a certain criteria of certain returns, and then you have to dispose the asset, which again, that's just the model that we follow. Is that going to change? It has changed for us personally. There are some properties that we want to hold for the long time, and those are the highly cash flowing assets. Again, those are properties that we bought with two or three partners, and because we have a small decision making body, we can pretty much, once that everybody agrees that this is a property that is cash flowing, we want to keep it, we keep it, we refinance, get all of our money out, and keep it as a legacy property. So, but what we saw again in the room was that they're sold too early, or failed to start too early enough, and then that they failed to diversify. And so it was really interesting room. So I would love to hear what your takeaways are. Let's see. I have a couple questions here, so let me thank you for the comments. All right, talk a little bit about your fund. Does the cash flow, and how does the fund pay, and what intervals? Okay, so yes, the purpose of this diversified fund is that it pays 6% cash on cash annualized to investors, and how often it pays every month. Once that 3 months after your capital is seasoned, so three months after your capital is invested, you start getting paid every month, 6% annualized of the invested capital, and the holding period is 5 years with a discretionary um, period to extend that to 7 to 10 years if needed or if the property requires it. So that's about the fund. What is the average time frame to close a property from finding the deal to closing? And in what phase of the PPM will you be sending out the what phase the PPM will be sent out to potential LPs. We talked about this earlier about the PPM, so I'm not going to cover that. But in the average, it takes about 6 months, 5 to 6 months, and sometimes longer to close on a property from the time that you actually have the property under contract. That's been an our average. All right. Thank you guys. Thank you guys. Thank you guys. Um, you make it since it looks so simple. We actually that's one of the comments that I refer to one of the speakers, like you make it sound so simple. And the reality is that so this is the thing that when people fails to invest or to get started with investing, it's not because they don't know enough. Education is not the reason why you're not investing. I guarantee you, you have everything you need to know as of right now. I mean, I don't, I mean, I'm thinking like if you've been in the education mode for at least 6 months, you have all the information that you need to know. And the next step is to invest. And the reason why most people don't invest is because they don't trust themselves. And the reason why sometimes we don't trust ourselves is because something that we did, some kind of decision that we make, that we saw somebody or that somebody told you that they make an investment and they lost money or they make the wrong investment or they now have feel trapped and feel like they have a job. That is the reason why we don't invest. So the sooner that you learn what is it that is holding you back and you fix it, the sooner that you're going to actually see the growth. Like right now, I can guarantee you, probably 99% of you are on your own way to success. Like you are blocking yourself from taking the next step. And the next step can be like, let me just start by being an investor and being, putting some money to work. Right now, we have an opportunity that welcomes you with $25,000. Like this is against our mentor's advice. His advice is like get four people to give you $500 each. That's exactly what he said. But we are, no, we want to make it available for other people. The people don't have the capital, like fully capitalized. We want to open this opportunity. And what we see is the people that is bringing the 200 and 500, 250, $500,000 investments are the ones that are like, yeah, here's the money. And those that actually needed to get started are still staying on the way to their success. So if that's you, you really, really need to like think about it. What are you doing and how serious are you about growing your wealth? And who is going to be telling your story? And who's going to be telling your story that my grandma, I'm thinking of my granddaughter telling a story about me. My grandma went and educated herself for 5 years. She was studying real estate, and then finally she got one property and she lost it. And guess what? She never did it again. Like I don't want that to be my story. I don't want that story to be told about me by my loved ones, those that deserve and those that I'm actually working for, to make them proud, to leave them something behind, to teach them like how this economy is actually set up to help those that actually invest instead of going to work and earn their own income with a W-2. The system is set up so that it penalizes those that are actually working hard and paying taxes. I'm not saying not to work hard, but what I'm saying is that you need to find the ways, and I believe we share enough that you know that the things that you need to do. So right now, again, back to where you are, the reason why you're not moving forward is because you don't trust yourself. So think about it. What are the things that you need to unlearn? Don't think about learning. Just think about what are the things that you need to take off your plate and unlearn because so that I guarantee you, once that you identify those things that you need to unlearn, you're gonna pull the trigger and you're gonna be like, I want to be an investor this year. This is the year that I declare I'm an investor, and you're gonna pull the trigger. So if that's you, I hope that this resonates with you, because I guarantee you, once that you pull that trigger and you like become an investor and are an investor, you're gonna start seeing things in a whole different way. So again, let me get back to some of these questions, but I think I'm gonna cut this short. Let's see. Appreciate you guys so much too. Thank you. All right. I think this is all. Would you be, what would be your main reason to sell your properties? Okay. Well, that's my question here. What will be the main reason to sell the property? So when we buy with our own money, we want to hold. We want to hold for the longest time. The reason to sell the property is if somebody offers us a ridiculously high inflated price. Like we will get our capital and we put that money to work somewhere else. If we're invested in a joint venture, likely if the property is cash flowing and it's solid, we don't want to have to go do all the work of raising capital or getting the closing documents and exit selling the property. Is a lot of work. So if the property is stable, maybe we refinance or we just hold it and we continue to hold it. So that's in a joint venture. On a syndication, the main reason to sell the property is because you have met the returns that you projected to achieve to your investors. So once that you achieve the projected returns, then any extra day that you hold the property, you're running the risk that something might happen to the property, maybe a fire, an accident of some sort, something breaks. And now, if you're not capitalized, you're going to need that cash flow that is coming in. So you're going to need that so that you can pay the fixings. So once that you achieve your projected returns, that's what you projected to your investors, deliver to the investors, and then move forward. Again, a different model for a different type of acquisition, but that's how we actually do it. Do you have to be accredited to be in the fund? No, you don't have to be accredited. We welcome sophisticated and accredited investors. However, we have a limited amount of seats available for sophisticated investors. That's not my rule, is the SEC rules. We can only welcome up to 35 sophisticated investors, and I have to do the head count, but I think we have probably about five more spots available for sophisticated investors, because we have been getting a lot of great attention for this property acquisition. So, but if that's you and you want to invest, I highly encourage you to text me. My phone number is 512-900-9763. Text me and we can timestamp your interest form, and that way you have time to ask any other questions. But definitely, I think we have like five, maybe six in seats for sophisticated investors. Okay. I think I claim that I shared that. You just need to, that's right. You just need to jump in. What is the minimum investment? So the minimum investment for the property that we are acquiring, which is at 34 units in Houston, Texas, it's at $25,000. And for the fund itself is 50,000. But if you're investing directly for the deal, so it's $25,000. Again, if you have any questions, just text me. If you're listening to this a year from now, this doesn't apply. So please forgive me on all this. Just skip and go to the next video. All right, guys. Thank you so much for being here. Thank you so much for the support. And again, if you're taking this investment, the investor journey seriously, because you need that, because you want to preserve that wealth for your family, you just need to like apply all of with everything that you have. Every single cell of you should be working towards making things happen. Don't put yourself on your way to success. Make sure that you are in the community, and just keep staying connected with us or other communities that you feel like that affinity. But don't delay putting your money to work. Okay. Phone number again, 512. Let me put in the chat. 512-900-9763. I put it in the chat. And the next event that we have is going to be the first Saturday of the month, we do an investor update. So if you're one of our investors and you want to come back and see what are we working on, what we have in the pipeline, we often present information that about the deals that we're pursuing. Just want to keep you on top of things. We talked about anything about the portfolio and how the portfolio is doing. So if you want to come back, join us. If you are not invested yet, but you intend to invest, just send us a text and we'll send you the invite. Again, this is for our investors and partners only, okay? Thank you guys. Talk to you soon and go crush it. Happy investing.